What's going on, YouTube? Today we're going to talk about Warren Buffett, one of the greatest investors of all time. Now this man's worth 84 billion, so if you could do at least 1% of what he does, you're going to be in great shape. So we're going to take a look into what Warren Buffett looks at, how he buys his stocks, and how he got rich. Okay, so the first thing you want to know, every year companies come out with the annual report called the 10K. It comes out, the company reports how much money they made, how much revenue they have, what their gross profit margins are, all that good stuff. And so today we're going to dive in and see what that's all about. Okay, so the first number that we're going to look at is the revenue. And basically this is all the money that's coming into a company. Now, if you have high revenue, that's great, but what also matters is your gross profit margins. And that basically means what is the percentage of your profit in relation to your revenue. So if you have a sales company and you're selling a whole bunch of items but your margins are very small, that means that your gross profit margin is going to be a low percentage. Typically you're going to want a higher percentage. And so for a company like Amazon, I think their gross profit margins are very low, but they do a lot of volume. But if you compare that to a company like Apple and you look at their gross profit margins, it's much higher because basically they have the intellectual rights and patents for their iPhones. And so this is basically two different styles, but in general you do want a higher gross profit margin. Next on the income statement is the operating expenses, and typically you want to keep these very low because the idea is that the less operating expenses you have, the more money you're going to bring in. That is the sign of a healthier business. If you have operating expenses that go through the roof, like companies that have high research and development or have high marketing costs, you basically want to avoid these kind of companies because one bad year where they don't hit their revenue stream, now they're dealing with a whole bunch of overhead costs that you don't want to deal with. So looking into these costs is very important in Warren's opinion. Now, also, such things as depreciation for buildings and machinery. If the company manufactures products physically in the U.S., that's something to look out for because increasing labor costs and breakdown of machinery, high maintenance costs to keep the machines running at full capacity. These are all things that cut into the profit margins of a business. Next number on the income statement that I want to look at is the earnings per share. Now this is my favorite number. If the earnings per share are trending up and up and up, this is the sign of a great business, and you can expect that number to keep rising at a great rate and your stock investments should go up. This is probably the number one rule for stock picking, is a company that has a proven track record of EPS gains and has shown steady progress where year over year over year it just keeps going stacked up. Like racks on racks on racks. So that's what I mean. You want to have a high EPS. Talk about is the balance sheet. Now the balance sheet is kind of like a snapshot of the health of the company at a particular date. Before we're talking about the income statement, and that's kind of like a period. So usually on what they call a 10K, those are quarterly reportings. So for 3 months, this is how much money the company made in revenue, in profit, in gross profit margins. But now we want to look at the assets and liabilities of a company. So this is just kind of a snapshot and a health of the company. And you're going to be able to take a look at how much property under management that they have, what kind of equipment they have, how much cash in the bank they have. And so these are all signs that if the company is doing well, those numbers will be higher. And typically you want your assets to be much greater than your liabilities, same as like a house. Like if you have your house paid off in full, all the assets are pluses, zero liabilities, that's probably the best. And obviously a company never has zero liabilities, but that's what you want to shoot for, is a higher ratio of assets to liabilities. So drilling down into the assets, probably the best number to look at is the cash on hand, because that just tells you how much cash the company has. money in the bank. So you know what I'm talking about. And all those other numbers, they just kind of tell you what their inventory is, how much receivables they have. This just tells you how much, where they are in their business cycle. So if they have a lot of inventory, it just means they haven't sold it yet, and hopefully they will be able to sell it. They don't get stuck with some bogus inventory. And then receivables, basically what the clients or vendors just haven't paid the company yet, and they're going to get that money soon. So my favorite number is the cash on hand. The book also goes into property under management, and actually Warren says that this number being lower could actually be a good thing, because that's less property for them to manage, less depreciation costs, less maintenance upkeep. The book also goes into goodwill and intangible assets. For me, these are kind of minor. Warren goes into detail about what he expects of them, but basically includes like patents and other intellectual property that you can't really put a price on, so they kind of put it into this intangible assets category. The one thing that I will say is the long-term assets. Warren really likes that, because that kind of basically shows that the company is invested for the long term and they have good future prospects, and they're doing smart things with the profit that they've made. So it really shows great health to a company and the longevity of a company. Okay, let's talk about accounts payable. Now, a company has accounts payable when they've bought goods and services on credit, and now they need to pay for those services, and so they have not yet been invoiced by the supplier of the service or the other product that they bought. So that just means that these accounting procedures have accounted for the expenses that have gone to buy those things, and yet the other company hasn't invoiced for them. And you know, typically companies will invoice things and they want their money in 30 days. So this is just kind of a snapshot on the liabilities sheet that companies are due to pay their money for. And now we get to the short-term debt. This is one of the items on the liabilities that can really kill a company, because short-term debt tends to have higher interest rates, and so this can be really insidious to the health of a company. If they're taking on a lot of debt and they don't meet their revenue numbers, then this could be disastrous for the company. And the difference between short-term debt and long-term debt is that short-term debt is due within 1 year, and long-term debt is due over many years, so it has more of a payment structure. But either way, these are liabilities on the company, and no matter what happens, the company needs to pay these expenses. So it's kind of a double-edged sword to take on debt, because number one, you have access to more capital. That's the upside. But the downside is, well, basically you have to pay off this debt. In a determined structure, it determines what kind of debt they took on, short-term debt versus long-term debt. So now that we know a little bit about assets and liabilities, one of the most important numbers is the book value. And so if you go to that snapshot and you say assets minus liabilities, then you're going to see that if you subtract those two things and divide by the number of outstanding shares, then you get the book value of the company. And typically you're going to, when you buy a stock, you pay a multiple on that book value, which is called the price to the book value. And this kind of indicates how well the company is doing. It's an indicator of the long-term prospects of the company, and if they have great returns on their book value, and this will be great for the long term. And also, another thing that Warren likes to look for is the treasury stock. If he sees the treasury stock in the statement, then that's going to show that the company participates in share buybacks. And it's a great indicator when a company buys back their own shares on the open market, because they feel that their stock is undervalued, and it kind of shows greater long-term prospects because they believe in their own company that much that they're willing to buy their own shares. And then on the shareholder side, it increases the earnings per share because the number of total outstanding shares has decreased because the company has bought back their own shares. So now less shares on the market, and that means less shares to divide the profits with. So that means that each share gets greater earnings per share. I hope that made some sense. A very interesting and controversial take on dividends. He really doesn't like companies that pay out a dividend, and his holding company called Berkshire Hathaway does not pay a dividend, and it never will pay a dividend. And so it's interesting to note what a company does with all that excess profits after the year. And basically it goes into a line item on the accounting sheet called retained earnings. Now, what a company does with the retained earnings is totally up to them. They can choose to pay a portion out through a dividend to all the shareholders, and they might get like 20 cents, 50 cents for each share, or it could be a high dividend in relation to what they paid for it. But a lot of companies actually can choose to use all that excess money to, number one, buy back their own shares. Warren really likes that idea. Or number two, just hold on to it as retained earnings. And so now the company can choose to do other stuff with that cash, as in reinvest in the business. And Warren really likes the idea of growing businesses when they have great retained earnings, because basically they can turn that extra dollar that they just made last year and make that into $1.20 next year, or make that into $1.30 next year. Whereas if they pay it out to you for $1 here, then it's just returning value to you, but that might not necessarily reflect next year in the share price as an appreciation. So it's kind of an interesting take. It really depends if the company is still growing, what they're going to do with the retained earnings. Typically, the companies that are growing, they just hold on to their retained earnings. Companies that are slowing, they give them out through dividends, and they're called mature companies. So kind of an interesting take on the retained earnings. It's really up to the management and what they feel they can do best with them. It's interesting to note Warren's take on bonds and equity. Now, a bond is something that you can take out from the government, say the Treasury yields, and it typically varies. I think right now it might be at 2.8%, maybe 3%. And so basically, if you take out a long-term Treasury note and you get 3% out, Warren says that that does not beat inflation because the rate at which the government prints out the money is a lot higher than 3%. He says it's around 5%. But interesting to note, Warren actually sees buying equity, also known as stock, equity in a company, and he views that as a variable rate bond. So he tries to choose companies for the long term that have long-term competitive advantage, but basically have bonds. It's a variable rate bond, so you don't know what it's going to return to you every year. It might be different one year and then different to the next year. But he says typically over the long term, stocks do much better than bonds. So for Warren, it's up to him to really pick the companies that he feels have that durable, competitive, long-term advantage, and then just park his money there instead of bonds. That's his take on stocks. So I hope you enjoyed this video and I hope you gained some value. Please hit that like button, hit that subscribe button, and if you really like this book, I encourage you to go get it. Buffett and the Interpretation of Financial Statements. It was actually written by Mary Buffett and David Clark. It's a really great book. It's short. I think it's only, how many pages is it? It's only 200 pages, but the pages are like half-size pages with like spaces in between the fonts. So you can really read this easily, but it's got a lot of great information. So I hope you go pick this book up. It's great.